Welcome back. This week we're going to cover what's been going on in the offshore oil sector by reviewing a Valaris investor presentation slide deck that they put out recently. As of the time of making this video, Transocean has not made one, so that's why we're not reviewing it. And then after we review some slides in that slide deck from Valaris, we're going to jump over to the Transocean earnings call and see what they had to say. And to surmise it here, some things, pretty much all good news, even from, I didn't include Diamond, but good news from them as well. So what we're looking at is 12 to 18 month reactivation timeline at a cost of around $75 to $125 million, paid for by the customer. Day rates expecting to stay in the 400,000s and to increase for a larger and larger portion of the fleets as old contracts roll off and they get renewed. And they're also willing to keep rigs from being leased if it means that they have to compromise on the day rate of that rig, which is to say that they think that they have pricing power. And mobilization is being paid for by the customer up front in some of these instances. That's all a good, healthy, strong market for these players. I don't, what is it that Warren Buffett says? That you let the operating performance of the company dictate and distinguish itself, not the day-to-day market activity. So yeah, Transocean's gone nowhere for 3 months. And then, well, the S&P hasn't really gone anywhere for 3 months either. So is what it is. So, Valaris. This slide deck, what I want to emphasize, since is that Valaris is on the left hand of things and then Transocean is on the right hand of things. So, if the risk you want to take, assuming that you define risk as financial leverage and money owed, and if you're concerned that we might have a lull in the cycle and that they might have to get defensive in their positioning, whose balance sheet is healthier and stronger and can handle a pullback in the markets? And the answer is Valaris, then Seadrill, then Noble, then Diamond, then Bore, then Shelf, or Shelf and Bore, and then Transocean. So Transocean is the levered play. Do with that what you will. Then commodity supply and demand is constructive for our industry. Here in the top left corner, you see global liquid fuel consumption hovering around that $100 million on the vertical axis, the y-axis of the chart. And then COVID comes along and snaps it down to 85 million, wiped out 15 million barrels, 15% of global demand, which is interesting to think about because your bear case for oil is recession, but I believe in 2008 it removed 2 to 3% of demand, and then COVID managed to remove 15% of demand, but for roughly a month, and then it snapped back and is snapping back, and then plans on exceeding 100 million barrels per day. Then Brent crude oil forward curve in the bottom left-hand corner here, showing Brent oil in backwardation, which is one reason why I thought about buying some B&O ETF, but I didn't. So you can pick up that 1 or 2% roll yield every month. And then on the right-hand side is an interesting chart, which shows the offshore break-even oil prices for undeveloped reserves. Now, these are P50 reserves, which are reserves volume with a probability of recovery of between 50 and 90%. So make of that what you will, but what it's showing is that 93% of undeveloped reserves estimated to be profitable at $70 a barrel of oil. And it's safer to be bullish offshore oil with a conservative baseline than some of this triple-digit, parabolic, exponential move, blow-off top expectation, because that kind of volatility is not going to be good for the market, and if anything will be a point to sell. I would prefer things just muddle along, staying in a $70 to $90 range, and these guys really pick up and going and start cash flowing. That's what I would prefer, and that's my base case too. Offshore upstream capex and new project sanctioning are expected to increase. Record free cash flows in 2022 for exploration and production companies and attractive project economics are expected to drive increased investment in offshore projects over the next few years. Offshore upstream capex is expected to increase by 15% in 2023 and at a compound annual growth rate of 11% over the next 2 years. Growth in offshore spending expected in both deep water and shelf. Offshore project approvals are also expected to increase meaningfully over the next couple of years and are anticipated to be at their highest levels in more than a decade. All that sounds promising. Demand for offshore drilling is expected to increase over the next several years. Floater demand is expected to increase at a compound annual growth rate of 6% over the next 5 years. Approximately 2/3 of floater demand over the next 5 years is expected to be for exploration, appraisal, and development drilling. And this is a strong signal of customers' conviction on the economics for deepwater projects and is positive for a long-term demand for these rigs. Jackup demand is anticipated to increase further in 2023 and 2024 as operators with exposure to shorter cycle barrels are expected to ramp up production to benefit from high commodity prices. The primary driver of jackup demand is different than for floaters, with more than 40% of all demand over the next 5 years expected to come from infill drilling. Significant supply rationalization over the past several years has improved market balance. Benign environment floater supply has declined by 44% to 157 from a peak of 281 in late 2014. Benign environment floaters have fallen 44%, people. Okay? Jackup supply has declined by a more modest 9% to 493 from a peak of 542 in early 2015. Day rates have increased meaningfully since 2020, and this is worth understanding and knowing and realizing on a bigger picture, because you might be frustrated that your Tidewater, your Transocean, or your Valaris hasn't gone anywhere over the past few months. A little, up, down, there, it's all within a range, and that's a few months. This is, if you go from Q4 on this chart, it says Q4 of 2020, 193,000. Then on the right bar, it says Q1 23, 403,000. Now let's round those numbers and say 200,000 to 400,000. And it took 2 years, okay? So that's 2 years it took for it to increase by 200,000, which is to say it took 24 months. Which is to say that, what's the math? That's roughly $8,300 per month, each month, on average, that day rates increased, which sounds very small and subtle and fractional and insignificant, but it compounds and adds up. But $8,000 to $8,000 to a $200,000 day rate is 4% of the day rate, like whoop-de-doo, nothing to write home about. But it keeps piling up and adding up and adding up, and then there's that break-even point where everything afterwards, your fixed costs have been paid, and now it's all going to the bottom line in cash flowing. And that's crucial to understand. And we're hitting that point and are really getting ready to accelerate into that point if we can maintain in this market. Okay, we're done with that. If I remember, I'll put a link to in the description to that presentation, investor presentation, Q1 2023 Valaris presentation. Now on to Transocean and some things that they had to say that I selected for throughout the earnings call. With 12 total cold stacked assets, we have the most operational leverage within our peer group and significant upside potential in a rising market. particularly given the quality of our assets. There are only 13 remaining 6th and 7th generation cold stack drill ships in the industry, and 8 are in our fleet. 3 of these, the Athena, Apollo, and Milos, are 7th generation ultra deepwater drill ships that are well preserved in a relatively mild climate offshore of Greece. We expect economics of reactivations will be cost advantageous as compared to acquiring a stranded new build and preparing it for an initial contract. Recent stranded new build purchases suggest between $200 million and $250 million to acquire the assets, plus the cost of reactivation versus our current estimate of $75 to $125 million to reactivate one of our existing cold stacked rigs. Okay, so that's a lot of words. What that means is you want a rig, you have one of two choices. Either you go to a shipyard that has a stranded new build and you can buy it from them for $200 to $250 million. And then on top of that, pay for the activation of it to get it up and going. You have that option. Or you can get a cold stack from Transocean, Company A, Company B, whoever, and pay us $75 to $125 million of reactivation, which you're going to help pay up front, by the way, as well. So from an economic standpoint, you save, let's call it $125 million by going with the alternative, the latter one, which is to say that it's not costly enough to reactivate a cold stack that would make it more economical just to go out and get a new build. That time will come, but until then, we're not there. On to another piece. In summary, our outlook remains unambiguously optimistic, reinforced by increased market tightness in various regions around the world and the continued to upwards trajectory of day rates. Our industry-leading backlog increased for the 4th consecutive quarter to currently about $8.6 billion. Additionally, the average day rate on our working benign environment rig fleet is beginning to reflect a high-quality backlog we booked over the last 18 months, and it's projected across the 400,000 per day mark later this year. As more of our rigs transition to higher day rate contracts, we'll begin to utilize cash generated from our fleet to fulfill our commitment to our broader deleveraging efforts. Our focus remains on delivering safe, reliable, and efficient operations. With our strong year-to-date fleet uptime and revenue efficiency of nearly 98%, we continue to take positive steps towards ultimately strengthening our balance sheet and generating value of our shareholders. Okay, what they're saying is we're on top of the ball, we're making money, we're staying up and running, we're doing things efficient, and as old contracts roll off and new contracts roll on, we're going to collect that premium of that 400,000 per day rate. And with that additional capital, that cash, we're going to start trying to delever some, however that much is. But they're going to start, and by the way, I believe this last quarter they actually also paid off, to make things even more bullish, if you're not bullish enough offshore, that I believe they took it upon themselves to pay off some debt that wasn't due, that they just paid it off. Now, if they were fearful of any current or present or near-term structural issues of offshore, they probably would have sat on the cash and not deployed it into buying down debt that's not due for maturity for some time. So, another positive takeaway. Here Eddie is asking a question saying, "Hi, good morning. So you announced a handful of nice contracts for harsh environment semis this past quarter, but notably absent were contracts for the Invictus and the Inspiration, especially given their near-term expiration of their current contracts. Both of those rigs are also in the Gulf of Mexico, which is effectively a sold-down market. So could you just talk about the future prospects for those two rigs specifically and when we should expect them to get back to work?" And goes on to say, "Yes. So obviously I can't tip my hand to this precise opportunity we're exploring, but yes, we're in active dialogue on both the rigs for different things, and we expect that fairly shortly we'll be able to add some more backlog to those. And kind of a reminder on that contracting philosophy, we are purposefully keeping a couple of rigs available in the near term to take advantage of this improving market for us. So you did see, and thank you for noting the prolific contracting that we did on many of the assets over the last couple of quarters. So we maintain that balance of, yes, it's nice to have the majority of the fleet on long-term contracts, but we certainly also want to be able to capture the upside in the improving market, which is to say, delayed gratification. We're not going to jump in to contracting and leasing those rigs out to first come, first serve. We have standards, and we want those standards to be met, and we see things are looking up and aiming up and doing well, and that's what we're going to contract our rigs to, and not be necessitous and have a opportunistic and abundant mindset, and not a mindset of scarcity. That's what they're saying. That's what he said. So either he's a greedy fool or the fundamentals are indeed improving. Okay, we're getting close to the end. Thomas says, then just last comment, great, thanks. And then just last comment still related to the supply. Thanks for the range of 75 to 125 million on reactivation. But can you maybe update us on the timeline to reactivate a cold stack drill ship in the market? Obviously aware that there are going to be a range of depending on the assets, but just kind of broad strokes reactivation timeline ranges. And then maybe an update on how you see supply chain, whether there are major hurdles to reactivating rigs, potentially based on equipment availability. Thanks. Yes, Thomas. This is the answer. I think our guidance on that still hasn't changed since the last time. We're still looking at anywhere between 12 and 18 months to get a cold stack reactivation effective door to door into operation, largely probably around the 15-month side. The supply chain side is improving as capacity is getting better across the supply chain, but we're still facing some long lead issues, particularly on heavy steel forgings and obviously on electronic components that there's a reliability probably issue in terms of delivery in the supply chain from Europe in that regard. But I think we're still seeing 12 to 18 months range on our cold stacked reactivation at this time. Which is to say that even if someone wants a cold stacked fleet and say, okay, you know what, I'm not going to buy the stranded one from a shipyard in Southeast Asia, give me one of your cold stacks. For you to say that, you're going to put up this 75 to 125 million or some portion of it to help reactivate that rig. Then you're going to wait for 12 to 18 months, which means that you're contracting for something that's going to happen in 1.5 to 2 years. Like the time horizons are not what people are accustomed to. It's like, imagine you wanting to buy a laptop or a microwave or a car or anything, and you have to wait 18 months. And we'll end it here. This is the last one. The other thing I would like to mention, in addition to these having day rates firmly in the 400,000s, if not higher, customers are paying mobilization fees as well up front. So you layer that in as well, and it looks pretty lucrative for the market. Right? This is all good news. So the customer has to pay for reactivation, or at least some of it. They have to pay for the mobilization. They have to pay. Then they have to sit around and wait. There's not that many other options. I mean, it's looking pretty good. So leave it at that. Now on to the weekly performance. Chop, chop, chop is what it is. I did it. I bought a share of PacWest. One share is 1% of the portfolio, so I really don't care. That thing has done incredible in volatility. If you recall, I purchased it there at the end of March, held it for a weekend, made, I don't know, a few percent, we'll call it, sold it, couldn't handle it. I thought $10, good enough price. And then it fell down in this past week. It went from, I don't know, $10, $11, and it fell all the way down to $2.50. And then now it's trading at, we'll call it close to $6. And I was like, I thought it was good at 10. Let me take a bid on 1% of my portfolio and see what happens. And we'll see what happens. Transocean's bouncing around. Valaris is bouncing around. These aren't the intraday lows. I think at some point this week, Transocean was down, I don't know, 11, 15%. Valaris was down. I mean, a lot of volatility, a lot of nowhere. It's a lot of chop. It's so frustrating to see, your portfolio up 10% one week, then down 9% the next week, and then you've had numerous 5 to 15% swings in your positions or your portfolio as a whole, and then it comes to the end of the month and you tally everything up and you're like, oh, I'm down 0.8% this month. And then the next month, same thing happens and you're like, oh, I'm up 1.1% this month. And here you are taking blows to the body each and every day. But that's the name of the game, and that's why a lot of people don't cut it, because they can't take the volatility. They dump out and then they try to buy back in. And I mean, look at the S&P. It's in the same spot. It's in the same spot it was in February. It's gone nowhere since, I think, like February 2nd or something. It's just 3 months. Nothing. Oh, it's chopped around a lot of dramas happened, banking thing, this, debt ceiling. So when it's all said and done, look at Louisiana Pacific. These, the home builders, many of them, Green Brick, I think shot up yesterday. It was like 25%. Now, Blue Links shot up on earnings because pretty much all my shares had earnings this week, except Kinross. Transocean did not fare well. Valaris didn't fare well because even though they came out with earnings that was relatively decent, oil was getting smashed and was down 4 or 5%. And so that didn't help. And then Blue Links, which I don't own, but the building product supplier, they were up 15% on earnings. They're a very volatile, wild stock company. And then Louisiana Pacific was up, like 6 or 8%. And then it gave it all back, and now it's making it back, and blah, blah, blah. Just Boise Cascade. Builders First Source, which is the one that I'd like to own, but seemingly that day's not going to be today. And it was up 12 or 13%. It's just phenomenal movements. And it's volatile. And the only thing more irritating than chopping around for months at a time, taking body blows, not really going anywhere in your portfolio, is for the market to finally just drop out and fall like 15 or 20%. And you're like, oh my God, like not only like I took all these blows in the volatility, staying disciplined and not buying and adding tactically, for just to dump and puke on me. It's like, and I'm not predicting that'll happen this summer, but well, let's just also say I'm adding to my cash position. So see what happens. Thank you for watching. I appreciate it. And until next time.